Today's tech news moves fast, but understanding it shouldn't be hard. That's why Snarful Solutions Group brings you Connecting the Dots, where we break down what's happening in tech and why it matters to you. Now, let's dive in with your hosts.
Imagine handing your engineering team a corporate credit card in January, and by April, finding out they have completely blown through the entire year's software budget.
Yeah, that sounds like a pretty catastrophic accounting error.
It really does. But that is exactly what just happened at Uber. And the culprit behind that massive bill is artificial intelligence.
Wow.
Yeah. So today we were looking at the severe reality check hitting the tech world and why the blank check era of AI is officially over.
Welcome to Connecting the Dots, broadcasting daily from Snarful Solutions Group right here in Sacramento, California. I'm Morgan.
And I'm Alex. Today is Friday, June 26, 2026. And before we get into this massive shift in the tech landscape, let's get you caught up on what's happening outside your window and in your wallet.
Definitely.
Locally here in Sacramento, we are looking at a beautiful sunny day. We've got a high of 82 degrees Fahrenheit with winds blowing around 9 to 15 miles per hour.
Sounds perfect. But, if you are listening from outside the capital region, you will want to stay a bit more vigilant.
Oh, for sure.
Yeah, we are currently tracking 318 active U.S. weather alerts right now, and 200 of those are actually happening over land.
That is a lot of alerts.
It is. So please make sure to head over to weather.gov to grab the specific safety details for your local area.
Now, looking at the markets, we have some really fascinating movement. The Dow Jones closed on Thursday at 51,920.62.
Right.
That is a slight drop of 88.40 points for the day. But, if you zoom out, the index is actually still up over 348 points for the week.
Not bad at all.
Not at all. The S&P 500 closed at 7,357.49, which is a drop of 47.42 points. And checking in on crypto, Bitcoin opened this Friday morning around 59,706, but it has since dipped a bit to 58,737.34.
The underlying narrative behind those numbers is basically a story of two different economies right now.
How so?
Well, we are seeing intense volatility in the tech sector, which, by the way, ties directly into our main story today. But the non-tech sectors, they are actually having a phenomenal week.
Oh, interesting.
Yeah, the traditional non-tech companies are stepping up and doing the heavy lifting right now. They are keeping the broader market relatively stable while Silicon Valley works through some pretty severe growing pains.
That makes a lot of sense. And hey, we have some great news on the sports front to wrap up the week, too.
Oh, yes, we do.
The Athletics beat the San Francisco Giants 9-6 on Thursday.
Such a good game.
It really was an incredible performance, especially from Jeff Hartley. He really stepped up to secure the win as the pitching hero of the game.
Yeah, just a fantastic game to watch.
All right, let's unpack this.
Today's episode is brought to you by Strong Coffee, the premium instant coffee that tastes like a traditional brew, but is packed with 15 grams of protein, MCTs, and adaptogens like ashwagandha. Get clean, sustained energy without the jitters. Use promo code SNARFL for 20% off at strongcoffeecompany.com.
So we are looking closely today at a really massive financial reckoning inside the artificial intelligence industry.
Yeah, reckoning is the right word for it.
Over the last couple of years, AI has basically been treated like magic by corporate boards. The mandate was just, implemented everywhere at any cost.
Right, just get it done.
Exactly. But the bill is finally coming due. And the sticker shock is sending shockwaves from small local startups straight up to the global stock markets.
Because the core issue here is a fundamental misunderstanding of what computing actually costs in the AI era. For the last 2 years, companies have operated under a strategy known in the developer world as token maxing.
Which, that sounds like a cryptocurrency scam, doesn't it?
It really does sound like one.
But it was actually the prevailing corporate strategy. A token is just the basic unit of data an AI processes like a syllable in a word.
Right.
Every single time you prompt an AI, and every time it generates a response, it consumes tokens. And those tech giants charge you by the token.
The meter is always running.
Always. Under token maxing, companies literally told their developers to prioritize speed and capability over cost.
Just build it fast.
Yeah, maximize the tokens to build new tools quickly and just sort of assume the return on investment would magically appear later.
And, that strategy worked when venture capital money was essentially free, right? When the goal was just getting a product to market.
Yep.
But fast forward to today, and the financial realities are catching up fast. When we look at standard cloud computing like fetching an email or loading a web page, the cost is literally fractions of a penny. You are just retrieving existing data.
Right, it's super cheap.
But generative AI is entirely different. Every single time you ask a frontier model to write an email, it is running billions of mathematical parameters through massive server farms just to predict the next word. The compute power required is staggering.
Which brings us right back to Uber. They've fully embraced that token maxing philosophy to build out their customer service bots and internal tools.
And how did that go?
Well, the sheer volume of computing power they needed burned through their entire annual AI budget in 4 months.
4 months? That is insane.
It is. They have now been forced to implement these strict spending tiers, where some teams are capped at just $1,500 a month.
Wow. That is a hard pivot.
But what really fascinates me is how the smaller companies are reacting to this. Take this AI startup called Lindy, led by CEO Flo Crivello.
Okay.
They built their entire platform on Anthropic's Claude model, which is one of those massive premium AI brains. But the API costs were literally bleeding them dry.
So they had to make a change.
A huge one. To stop the bleeding, Lindy had to completely overhaul their infrastructure. They migrated 100% of their traffic away from Claude and switched to an open-weight Chinese alternative called DeepSeek.
And did it work?
Yeah. Crivello noted that their cost curve basically crashed to the floor, saving the company millions. He characterized the switch as a literal matter of survival.
We should probably clarify what open weight actually means here because it is so central to why this move saved them so much money.
Yeah, let's break that down.
When you use a closed model like Claude or ChatGPT, you are paying a toll to Anthropic or OpenAI every single time data passes through their proprietary black box.
Right.
An open weight model means the underlying architecture, the actual trained parameters or weights of the neural network, those are made available to the public.
So no toll booth.
Exactly. You don't have to pay a toll for the software. You just rent your own servers and run the model yourself.
I mean, it is the difference between eating every meal at a Michelin star restaurant versus buying the ingredients and cooking the meal in your own kitchen.
That's a great way to put it.
You still pay for the groceries and the gas bill, but you aren't paying the restaurant's massive markup. And this move by Lindy represents a much broader industry shift away from token maxing towards something called model routing.
Right. Model routing.
Yeah, I look at model routing like buying a Ferrari.
Okay, I'm listening.
If you buy a Ferrari, you use it to drive on the Autobahn. You don't buy a Ferrari just to drive to the end of your driveway to check the mail.
No, that would be completely ridiculous.
Right. But for the last 2 years, companies have been doing exactly that, using incredibly expensive, massive AI brains to do basic, repetitive tasks, like extracting a date from a calendar invite.
That's just such a waste of resources.
Model routing is the realization that you should build software that acts like a traffic cop. It routes the simple basic tasks to a cheap open-weight model and only sends the highly complex logic problems to the expensive frontier models.
And that traffic cop mechanism is essential now because the capital required to run those frontier models is completely reshaping the global economy.
It really is.
Yeah, and it is creating a severe fracture in the tech sector, which analysts are currently calling the K-shaped AI market.
Okay, we usually hear about a K-shaped recovery in economics, right?
Yeah.
Where the wealthy recover quickly, so the line going up, while the working class struggles, the line going down.
Exactly.
We are seeing that exact same divergence right now on Wall Street, but it is entirely based on whether a company is buying AI infrastructure or selling it.
Right, so the downward slope of that K is occupied by the software model makers and big tech giants.
The ones that are buying the infrastructure.
Yep. Microsoft and Meta have actually entered a literal bear market, falling 20% from their recent peaks. And the rest of the Magnificent Seven companies like Amazon and Google, they are in correction territory, down at least 10%.
Wow.
They're the ones spending billions upon billions of dollars just to build massive AI data centers.
And then the upward slope of the K belongs to the hardware companies, the ones actually selling the computer chips to fill those data centers.
Exactly.
Micron, which is one of the world's leading memory chip makers, they just saw their stock surge nearly 16% on stellar earnings. I mean, it feels like we were watching a replay of the 1849 gold rush.
Oh, totally.
During the gold rush, the prospectors panning for gold in the river mostly went broke. The people who actually made generational wealth were the merchants selling the picks, the shovels, and the denim jeans.
Selling the tools.
Yeah. The AI software companies look like the modern-day prospectors burning through cash, while the semiconductor companies are getting rich selling the shovels.
Because the market valuations for those software giants were built entirely on the promise of future efficiency. Investors rewarded them for laying the groundwork.
But the patience is wearing thin.
Very thin. Now, Wall Street wants to see actual bottom line profit, and the math just isn't adding up yet because the infrastructure is so incredibly expensive.
It's astronomical.
It is. Building an AI data center doesn't just require advanced processing chips, it requires unimaginable amounts of high bandwidth memory. The neural networks need to hold massive amounts of data in short-term memory just to generate those responses in real time.
Which, by the way, is causing real-world collateral damage for the average consumer.
Yeah, it hits home.
We are seeing this demand for memory chips bleed directly into the products you buy. Apple just had to raise the retail prices on MacBooks and iPads, specifically because they are facing severe memory shortages.
That is wild.
The global supply of these components is finite. So you are paying more for a tablet at the local electronics store simply because a massive data center in Virginia is buying up all the memory to run a corporate chatbot.
Unbelievable.
And when Apple announced those price hikes, their stock tumbled over 6%. They are caught right in the crossfire of this K-shaped divide.
And the ripple effects of that capital burn rate are shaking the very foundation of the industry, which leads us to the biggest prospector in the river suddenly reconsidering its next move.
Yeah.
The extreme costs and the resulting tech queasiness on Wall Street have forced the biggest name in AI to hit the brakes on going public.
OpenAI, the company that effectively launched this entire generative AI frenzy. The New York Times broke the rumor that OpenAI is leaning heavily toward delaying its initial public offering until 2027.
Wow.
And it all traces back to this exact market volatility.
Right.
CEO Sam Altman has a very specific target in mind. He wants the company valued at $1 trillion.
That is a massive target.
Huge. But there are very real internal fears that if they open their accounting books to a jittery Wall Street right now, investors will basically balk at the sheer scale of their computing expenses, and they will miss that $1 trillion mark entirely.
You really cannot overstate the psychological impact of just the rumor of this delay.
I believe it.
The entire global tech economy has been banking on the OpenAI IPO to validate the last 2 years of massive spending. When the market leader flinches, the global supply chain panics.
The international fallout was instantaneous and severe, wasn't it?
Very severe.
SoftBank, the massive tech investment conglomerate led by Masayoshi Son, they had placed heavy bets on OpenAI. Following the rumor, SoftBank shares tanked over 12%.
Ouch.
Yeah. Japan's Nikkei index erased its recent record highs, dropping over 4%. But the most dramatic reaction was actually in South Korea, where the Kospi index fell 5.8% and literally tripped circuit breakers.
For context, tripping a circuit breaker means the stock exchange literally pulls the emergency brake and halts all trading for 20 minutes just to prevent a complete market freefall.
That is wild. I mean, a 20-minute halt in an entire nation's stock market because of an IPO rumor in California sounds like an extreme overreaction. Why is South Korea so hypersensitive to OpenAI's timeline?
Well, it comes down to the composition of their economy. Nearly half the total value of the South Korean Kospi index is tied up in just 2 companies, Samsung and SK Hynix.
Okay.
And their primary export is the exact high-bandwidth memory chips we were just talking about. They are the central suppliers for the global AI infrastructure.
Oh, wow.
Yeah. We also saw Kioxia, a major Japanese memory maker, slide over 11%. If OpenAI hints that they might need to slow down their timeline, the hardware suppliers who depend on their endless server purchases immediately crater.
This leaves a massive lingering question for anyone trying to understand where this industry is heading. If the crown jewel of the AI boom is scared to face public investors, is the AI bubble finally bursting? Or is the industry just putting on its big kid pants and learning how to run a sustainable business?
The underlying data strongly suggests it is the latter.
Okay, so no burst bubble.
No, the technology itself is not failing, and demand is certainly not slumping. In fact, enterprise demand is surging right now.
That is good news.
It is. The revenue run rates for these top-tier companies are staggering. Anthropic is currently looking at a $47 billion annualized run rate. OpenAI is pacing closer to $25 billion.
Wait, let's pause on that term run rate because I think it is crucial for understanding the disconnect here.
Sure.
Saying a company has a $25 billion run rate sounds like they have $25 billion just sitting in the bank.
Yeah.
But a run rate is just taking their current monthly revenue and multiplying it by 12, assuming demand stays perfectly flat. It is a snapshot of revenue, not profit.
Precisely. The top line revenue is fantastic. The problem is the bottom line.
Right.
If you are taking in $25 billion a year, but you are spending $30 billion on server costs, electricity, and hardware just to keep the lights on, you have a fundamentally broken business model.
Exactly.
The industry isn't suffering from a lack of interest. It is just desperately trying to fix its cost structure so it can actually keep the money it makes.
Which circles us right back to the Lindy story. How do the tech giants fix their margins when the technology is inherently so expensive to run? They have to build smaller, cheaper versions of their own products.
And they are doing exactly that. Big tech incumbents like Google and Amazon recognize that if they want AI integrated into every small business on Earth, they cannot rely solely on the massive frontier models.
It's just too expensive.
Right. So they are aggressively building lighter weight models. Google just rolled out Gemini 3.5 Flash, which offers solid performance at half or even a third of the price of their flagship model.
The engineering behind those lighter weight models is fascinating to me. They use a process called distillation.
Right. Distillation.
Instead of training a massive neural network on the entirety of human knowledge so it can, write Python code, compose a sonnet, and pass the bar exam, they use the massive model to train a smaller, highly focused model.
Which is so much more efficient.
Exactly. You end up with a streamlined AI that might only be good at summarizing customer service emails, but it does so using a fraction of the compute power. They created the most complex technology in human history, and now they're racing to figure out how to sell a discount, specialized version of it just to survive the math.
Before we wrap up, a quick thanks to Old Glory, an iconic music and sports fan merch store. Perfect for the techie in your life. Use promo code SNARFL for 15% off at oldglory.com.
So to pull all these threads together, what we are witnessing is the definitive end of the AI blank check era.
It's over.
The honeymoon phase, where companies could throw unlimited capital at token maxing and just hope the profit would figure itself out, is over. Businesses are demanding ruthless efficiency now.
And Wall Street is reflecting that exact new reality. Investors are rewarding the hardware manufacturers who are generating actual cash flow today, while aggressively punishing the software giants who are burning through capital. And the global markets are absorbing the turbulence as industry leaders like OpenAI accept that they may need to delay their grand public debuts until they can prove their business model is actually sustainable.
It is setting up to be a highly turbulent few months for tech stocks, for sure. But ultimately, it is a necessary correction for the long-term health of the industry.
Absolutely.
But as we leave you today, there is a lingering thought worth pondering. We have talked extensively about how these massive frontier models are becoming too expensive for the average startup to run.
Right.
And we noted that the only entities with the infrastructure and capital to offer cheap, reliable, lighter weight alternatives at a global scale are the established big tech incumbents, companies like Microsoft, Google, and Amazon.
The big guys.
Exactly.
Yeah.
So if the sheer cost of cutting-edge AI forces everyone from local bakeries to multinational logistics firms to rely exclusively on the streamlined models provided by big tech,
Yeah.
are we accidentally building a future where just 3 companies control the basic digital logic of the entire global economy?
That is a very intense thought.
It really is something to keep in mind the next time you use a chatbot to route a simple email.
We're here to help at Snurful, so reach out on our website if you have any more questions.
That's a wrap on today's top stories. Remember, tech doesn't have to be complicated, and we're here to help connect the dots. If you've got questions or want to learn more, visit us at snarful.com. Thanks for listening, and we'll catch you next time.